Oric.
Guy Spire's story about advisors pushing conventional wisdom is interesting too. Even well-meaning advice can lead you astray.
Yeah, he learned that early on. Following standard advice on fees or redemption terms created problems for his fund later. He realized he needed to build a system, an environment that actively minimized that external noise and influence.
To protect his own rationality.
Exactly. Build a process to keep the cocaine brain and outside pressures from messing up your long-term independent thinking.
What about leverage and shorting? More pitfalls.
Big ones. Leverage, debt. It magnifies returns, sure, but it magnifies losses just as much. As the saying goes, one big margin call can ruin years of good work.
Wipes you out.
It can. Many value investors see heavy leverage as fundamentally incompatible with the patient safety-first approach. It forces your hand.
And a shorting. Betting on a stock falling. Sounds appealing sometimes.
Theoretically, yes, if a company's fundamentally flawed. But practically, it's thorny, as one source put it. Hard to find shares to borrow, fees can be sky high, and the risk of a short squeeze.
Where the price rockets up instead of down.
Exactly. Your losses can be, theoretically, unlimited. Walter Schloss found it uncomfortable. Many think it's more a way for managers to justify high fees than a reliable way to make money for clients. By cash flow, short cash burn sounds neat, but the execution is risky.
Okay, what about investing overseas? Does that diversification always work?
It's often an illusion of diversification.
Yeah.
Yes, you spread assets geographically, but in major crises or rallies, most global markets tend to move together anyway.
Yeah.
True non-correlation is hard to find in developed markets.
And international investing brings its own headaches, right? Regulatory, cultural stuff.
Oh yeah, huge complexities. Some countries, like South Korea historically, didn't even have consolidated financials. Makes analysis tough. Others, like Russia, you worry about government interference overriding shareholder rights. Regulations might be applied inconsistently.
And cultural differences.
Big factor. In some cultures, shareholder interests might genuinely come second to employees or national goals. That's tough for a value investor focused on returns. Many prefer markets with strong rule of law, clear corporate governance where shareholders are clearly prioritized. Predictability matters.
Makes sense. Finally, the big one. Knowing when to sell. The selling dilemma.
One of the hardest parts, even to the best, especially with growth stocks, where estimating that future intrinsic value is really tricky. Easier to buy right than sell right, often.
Monish Pabray has a clear rule, though. Sell when the price exceeds intrinsic value.
That's his guideline, yeah. Simple, valuation-based. The main exception might be holding longer for better tax treatment, like long-term capital gains. Relies on having a good handle on that intrinsic value in the first place.
But Jerome Bose has a different take. He might hold on longer.
He might. He argues some value folks sell